much. And so like she said, I'm David Rigg. I'm with Eide Bailly. I work in our Fargo office here. I'm a senior manager, and I work in the tax services department, mainly focusing on contractors and real estate developers. And we have a couple other speakers here, Adam and Andrea as well, and they will introduce themselves when we get going. But we'll start off. I'll just kind of run through what all we're going to cover today, and then kick into my section of the slide deck. So the agenda today, we're going to kind of cover the things that we think have changed or something that should be looked at this year with the new Tax Reform Act, and what are the things we can kind of plan around or make adjustments on tax filings or how we organize or do business. So first thing we're going to cover accounting methods and opportunities for contractors to change or get over to the most optimal method that's allowed. Revenue recognition changes. We're going to run through the new Section 199A deduction for qualified business income. Some opportunity zones, what are out there for opportunity zones and how that can be beneficial for your business. What has changed and what stayed the same with full expensing of fixed assets. The changes with Section 1031, like-kind exchanges. And we'll cover the new interest expense limitation and then also the new limitations on business losses. So to kind of get going, we're going to run through what new thresholds there are for certain accounting methods and how that can affect your guys' construction business. So, why is this something that's important? For contractors, if you have any contracts that run from one year to the next year, basically straddle tax years, the IRS says in Section 460 that you have to use percentage completion accounting, so cost to cost per percentage completion, unless you can fall in some other method that they have given an exception for. So that can be a big thing because the optimal proper accounting method can really change how you recognize revenue and how you recognize deductions. And if you get into the best method for your business, you can defer the recognition of revenue and hopefully accelerate the recognition of deductions. And why that's beneficial is let's kick the can down the road as long as we can, if possible, and defer taxes. Improper or less favorable methods can hurt your cash flow, mainly in the tax bill there. And then also, if you are using an improper method of accounting and then you get audited and the IRS comes back and says, wait, you aren't using the one that's allowed for you, they will change you at that point. And if you can voluntarily change instead, you're able to get a much more favorable, easier on the cash flow changeover and be able to maybe change them over a period of 4 years instead. So we'll kick in here. What all changed? So they expanded the small contractor exemption. So what I was stating earlier, that you have to be in percentage completion accounting unless you fall out of that. So there's an exception for small contractors that says that you can use a different method besides percentage completion accounting if you fall into this revenue threshold. And it used to be a $10 million threshold. So if your prior 3 tax years, your average revenue was $10 million or less, you could use an exempt method. Well, they expanded that with the new tax reform to 25 million. So under the new rules, if your prior 3 years were under 25 million of average annual gross receipts, you can use an exempt method. So what that means is instead of percentage completion accounting, you can go into one of these other types of accounting methods. And I have those listed down at the bottom, what qualifies as an exempt method. And that would be completed contract method, the cash method of accounting for your contracts, or accrual excluding retainage. And we'll kind of cover what that means here in the next slides. But the first one, the completed contract method, and there's a couple that are typically really big deferral methods, and then some other methods that are allowed and we don't typically see our contractors on unless they're in some sort of specific circumstance. But completed contract method is one that if we can get clients into, we are typically pushing towards, because in that one you're deferring all the income or gross profit from a contract until you've actually completed or substantially completed the contract. And the IRS calls that, has a test for that at 95% completion, or if the owner has occupancy of the building that you're building or the project that you're completing for them. So all income is deferred until it's completed. Also, all costs are deferred until it's completed. So you're basically picking up the gross profit once you've finished the job. Generally, we like to use this alongside an overall accrual method of accounting, and also we try to get in an accrual excluding retainages also, so that if you have jobs that you've started during the year and finished during the year, we can wait and pick up the income that's a part of the retainage on that job once it's actually been collected. I'll talk a little more on that part a little later. You know, one of the downsides to this, we're always deferring the gross profit until the contract is finally finished. This can lead to big swings in income because depending on the timing of your contracts and when they finish, you might have some years where your taxable income is really low, and then if everything kind of piles into the following year, you can have a big jump in your income, and you know, it's not following cash flow necessarily. You know, you're hopefully getting paid, you know, as you go on the project or overbilled on it, and you might have already, if you're not planning well, expended that cash, and then the following year you have this huge tax bill because your income is dumping into that year. So it's a great deferral method. You just got to be a little more cognizant of where you're at on the contracts and what's going to be picked up in the following year. And you know, that's something as a firm, when we're going through this with our clients that are on completed contract method, when we're always doing our year-end planning, and even throughout the year, we're trying to communicate with them that, you know, your tax bill is this year, but you have this carrying into the following year, and just so that they're aware of that. Another method that we'll use quite often with our what would be small contractors, by definition, is the cash method of accounting for their contracts. And this is, you know, kind of as it sounds, that income and expenses are recognized when cash is received or paid. You know, this is a very easy one to understand. You know, if your cash position went up during the year, you have income. If it went down, you probably have a loss. And you know, it's a little more you know, easy for understanding, and it also allows for some decent planning around the expense side of it. The downside is you don't always have control of when your customers pay. And if you're a contractor who's trying to be overbilled, you're probably getting overpaid, and maybe you're getting paid ahead of where you are on the progress of a contract. And sometimes that can lead to more income in a year than we want, but it's nice to be able to cut checks at the end of the year and be able to manage your income down if need be. This is also very similar to the completed contract method, that you can have swings in this depending on years. You know, you can have year to year, you can have a big deferral into the following year, and then end up having to pick up a bunch of income. So it's nice for planning. It's a little easier to plan around, but there's still the swings in the receipt of cash and how you're recognizing income. And you know, this one is, both of these two are going to vary greatly probably from your books. You might be on a straight accrual method, or your books might be kept on percentage completion, hopefully. You know, so these methods are going to be very different. If you're looking at your books throughout the year, they're not going to match up with what we're reporting on the tax return. Another exempt method that's allowed is the accrual method. With the accrual method, you know, this is what a lot of our smaller contractors are going to be on if they're using like a QuickBooks. You're recording income when you're billing. You're recording expense when you're invoicing, or recording invoices and payables. And you know, in this case, if you're using basic QuickBooks accounting or some other program like that, your book and your tax return are going to be very similar. You know, it's easy to see where you're at throughout the year and understand where you're probably going to be at the end of the year. This is typically the least tax efficient method, and we don't generally have our contractors on this method, just because if you're overbilling, you're having to pick up income when you're billing it and not necessarily when you're receiving it. The other thing that went along with this in the same thresholds is the expanded cash method, and this is kind of the same, kind of different from the cash method we just talked about. The cash method there, we were saying cash method without accounting for your contracts. This is your overall method of accounting for everything in your business. And with the new Tax Reform Act, they expanded the threshold for who's allowed to be a cash basis taxpayer from 10 million up to 25 million. You know, we would, if we're picking your cash basis for your contracts, we're going to also pick cash basis for your overall method. You know, same concept as before, as if you get cash in, it's income. If you expend cash, it's an expense. You know, on these, the completed contract and the cash method, the one thing to note on these, if you're a flow-through entity and AMT is potentially an issue for the owner of the flow-through entity, these are not exempt methods for AMT. So AMT requires percentage completion accounting, so there's always going to be adjustment on this. So you can't necessarily zero out income using these methods. If you change one year or have just a weird timing of contracts. You still have to think about AMT, and that you have to keep those contracts or all your contracts on percentage completion for the AMT calc as well. So here I'm just going to kind of lay out a little example. I mean, this is very, very basic, but just to kind of show the difference between the couple methods that I talked about that we would prefer to have clients on. And this is just saying a small contractor, so someone who is under that $25 million threshold, has $500,000 of income in a year using the percentage completion accounting method. At year end, if they have 100K of profit recognized on the jobs that are in process, and they have a couple $100,000 of receivables and 50K of payables. So if we're electing one of these other methods, what does that mean? If we elect completed contract method, if you see up there that they have 100K of profit recognized on jobs in process, we would be able to pull that out of their calc. So instead of having 500,000 of income for the year, they would have 400,000, because we're saying they weren't complete. We don't recognize the income on those until they're finished with the job. If we were to change over to the cash method of accounting, this is just a very, very basic understanding of it. If we're saying that they have 200,000 of receivables at year end and 50K of payables, well, they've got 500,000 of income to start with. If they have not received cash on that 200,000 that's sitting in accounts receivable, that would be pulled out. And since they haven't paid those 50,000 of payables, those would also be pulled out. So 150,000 of income in this example would be deferred. So you can kind of see how you can push income off using these two methods. I'm listing, what are the most impactful method changes, and you'll kind of look back at these previous slides decks, and it's kind of apparent. But if you're changing from accrual method, so that would be if you're just straight accrual, not even worried about percent complete, into one of these other methods. Accrual is typically the least efficient, like I'd said before. So if we can change from that into one of these small contractor methods, that's generally a good deferral for the contractor. Or if you're in percent complete for long-term contracts, if we can change from that into one of these exempt contracts, usually we get a pretty good deferral pickup that first year. Also, if you're changing from accrual to accrual excluding retainages, and that's on non-long-term contracts. And I had mentioned that earlier. If we were doing completed contract method, this is one where we would typically also change this in conjunction with it. And what this method does is it says if you've started a job during the year and finished a job during the year, so not a long-term contract by definition of the IRS, you can look at the retainages that might be out there on the job and defer recognition of that revenue until the retainage is paid to you. So if you have 5% retainage held on a job and you finished it during the year and then collect it the following year, you can defer that 5% until it's actually collected. And the flip side of that is if you're holding retainage on subcontractors, you also don't get to take that expense until you pay the subcontractors. We have to look at the net of those two. But depending on the state you operate in, and if you do a lot of governmental jobs, some states hold a lot of retainage. Some private contracts do as well. But this is a great, easy method. That's an automatic method change that we can do to defer. The other one, I guess, change in deducting qualified prepaid expenses. This is one, similar to cash method, but if you're on accrual, you can kind of get to cash method on prepaid expenses and actually deduct them when you pay them. So if you're prepaying insurance before year end, you can take the deduction in the year you've paid it if we change to that method. So this is just kind of highlighting how we would actually change, but you have to let the IRS know that you're changing to tax method. So you have to file a Form 3115 to notify them of that. And a lot of the method changes, especially the ones where they're changing the threshold here, if you're changing over from percent complete to one of the exempt methods this year under the small contractor exemption, that is an automatic method change that you file the form, the IRS accepts it. You don't have to pay a user fee or anything like that. You file the forms with the tax return when you've filed it, including extended returns. And I guess noting on the bottom there, even if you're incorrectly using an exempt method and now it is an allowed method, we should file this form as well just to get you right with the IRS. A few of the other changes when you're changing on long-term contracts aren't necessarily automatic method changes. Most of what we've covered today are. If you're not doing an automatic method change, you have to pay the IRS a user fee and you have to file it before the year end you want it to take effect in. So you can't retroactively do one anymore for last year. So we've got a polling question here. I'll pass it off to Amy.
All right, our first polling question, true or false? The Form 3115 is filed with the IRS to notify the service of your intent to change methods. All right, the first polling question is now open. We're going to leave the poll open for about another 10 seconds. And if you're looking for CPE, please remember that you have to participate in the polling questions. All right, we're going to close the poll and hear the results. All right. Go ahead, David.
All right, thank you. Yeah, and you can see for the most part, we picked true there, and that is the correct answer. That if you're changing accounting methods, you do have to notify the IRS of your intent to do that. So with that, I think I covered what I have here on the contract methods and what has changed in them. So, the main thing there to focus on is that, there may be some opportunity here to change accounting methods. Maybe you were on one that was the correct one before, and now you're allowed something different. And just talk with your tax preparer and look to see, are you on, the one that fits your business the best and helps you the best with cash flow. And that's an opportunity that we have to improve cash flow. And a lot of times it's something we can look at after the year end here and do with the filing of the tax return. So with that, I will hand off here to Andrea. Oh, click too far.
Perfect. Thanks, Dave.
Yep.
So in addition to the changes that Dave just talked about, we also have some changes coming our direction with regard to revenue recognition. And we have a bit of a collision course happening right now. So ASC 606 are new revenue recognition standards passed by FASB and IASB for financial accounting purposes that outline a new 5-step revenue recognition process to be used for financial statement purposes. Generally, those standards were effective for public companies for 2018 and private companies now for 2019. So for those of you who are not public companies, this is something that you're likely going to be working through this year. And in addition, tax reform added a few new sections to 451, which is the primary Internal Revenue Code section addressing revenue recognition for taxpayers, and they've slipped in a few changes there that unfortunately could have an impact on some in your industry and some of the items that Dave just talked about. So generally, I'm not an auditor. I'd never claimed to be an auditor, and so I'm not going to go through this in detail. Effectively, this is the new 5-step process for GAAP revenue recognition purposes. And as you can see from the description of the steps here, this is a very principles-based approach. It is not a industry-specific approach. It's intended to apply across the board, and it's intended to apply to businesses and taxpayers across a number of different fact patterns. And so this is the process that your auditors are likely going to be walking through with you as you looking ahead on recognizing this revenue for financial accounting purposes. For tax purposes, as I said, there's two main sections that got added to the code as part of tax reform. So section 451B says that for tax purposes, our revenue recognition historically has been based on a 2-step test called the all events test. And taxpayers would apply that test, and then they'd apply a different standard. So for example, we've got our 5-step test now for financial reporting purposes and our 2-step test for tax purposes. And in some cases, we're coming to the conclusion that they could recognize revenue for tax purposes later than they were for book purposes, which of course the IRS didn't appreciate, because that sort of gives the taxpayer the best of both worlds. They get to pick up the income in their financial statements, which makes their investors and their lenders happy, and they don't have to pay tax on it. And as Dave just said, that helps them from a cash tax perspective. And so the IRS decided to add this section to try to limit the ability of taxpayers to defer recognition of revenue after the date they picked it up for book purposes. We have an example in a minute that we'll walk through to kind of illustrate how this could work. One of the nice things about this rule, though, is that it is only going to apply if the taxpayer has what they call an applicable financial statement. And generally, that's going to be a certified audited financial statement. It's something that's filed with maybe the SEC, perhaps with your lenders, with other government agencies to support your contracts. You would be subject to the new 451B rules, as well as the example we're going to talk about in a second. However, there's this lovely little exception in the statute that says it doesn't apply if you have a, quote, special method of accounting. Well, they haven't told us what that means yet. So unfortunately, we don't know for sure if there's going to be an exception available to people in your industry who are using some more complicated accounting methods. As Dave just talked through, you have long-term methods, you have non-long-term methods, you have overall methods. This is a very complex industry from a method perspective, and so we have some hope that the IRS will cut us a little bit of a break on this, but at this point we don't know for sure. And the other component of Section 451 that was modified is 451C. And this addresses a situation where you collect what the IRS calls an advance payment. An advance payment is where you get paid at the beginning of a contract for services or goods to be provided later. So maybe you're going to provide consulting services over the next 3 years, but you're going to collect all the money up front. This is generally going to apply to situations where you're using a non-long-term method. So, for example, you have some non-construction related activities. This can apply, and the IRS's position is, historically, even if you haven't earned it, once you collect the cash, you have to pick it up as income, which is very different than how these things are accounted for on your financial statements. But the IRS believes that cash is important. And so what 451C would allow us to do is defer that cash to the year after we pick it up. So if I have my 3-year contract that I'm collecting all the cash for up front, if I make an election under 451C, I can pick up part of it in the year that I collect it, and then the remainder in the following year, which gives us a little bit of a deferral opportunity for some of that cash. So if you do have those types of contracts, keep your eyes open, because this is an election that I think you may need to make. And so this is an example, as I said, under 451, and these facts are taken from a revenue ruling that the IRS issued back, I believe, in 1969. In that case, the taxpayer entered a contract with the government to construct boats. Under the terms of the contract, the government had a right to retain 10% of the amount payable until the boats were delivered and accepted by the government. The total price was $100,000. They'll take 6 months to construct, and the contract is entered on July 1st of 2017. The boats are completed by December 31 of 17, but aren't delivered and accepted by the government until 2018. And we'll assume that for financial statement purposes, we're going to pick up all of that revenue during 2017, since the contract was completed during 2017. So, for financial reporting purposes, as we said, we have $100,000 in revenue in 2017 because the contract was completed. Under the old rules, if you were using the accrual excluding retention method, we would only have to recognize $90,000 before the end of 17, because that last 10% that the government was allowed to retain until the inspection was completed, we would have argued under the tax rules that we didn't have a fixed right to receive that until the inspection was completed. Therefore, that $10,000 would have come in on our 2018 return, and so we would have had a favorable difference. We would have reported the $10,000 in 17 for book purposes, but deferred it until 18 for tax purposes. 451B is going to come in here and say, okay, great. We understand that that's how the tax rules work. We understand that under the tax rules, you could have deferred 10,000 of that into 2018, but we now, because of the new provision, you are not allowed to defer that $10,000 after you recognized it for book purposes, meaning that you no longer have a book tax difference on this item. As I said, we are still waiting for some clarity from the service on how exactly this rule is going to apply, if it's going to apply to everybody that has an audited financial statement. It sounds at this point that if you don't have an audited financial statement, you don't need to worry about this. If you do, what we're going to be paying attention to is any forthcoming guidance from the IRS regarding the special methods of accounting that are exempt, to see if we have an argument to remain on this method. If we don't, then we may have some accounting method changes to make for this issue as well. So, second polling question. In the revenue recognition 5-step process, which steps do you determine the transaction price?
That second poll is now open.
So Dave, have you had a lot of clients who have started looking at the financial reporting changes?
Yeah, I think we have. We've been pushing it a lot over the last couple of years to really look at, what you're doing and, how it's going to change your books and, just to get people prepared and familiar with it. I think, generally speaking, I don't think it's going to change too many of our clients. If you're using standard AIA documents, I think most of them are going to stay accounted the same as they have been in the past. But from a standpoint of what we do for a tax return, and I guess we, like you said, that's still kind of to be determined how we're going to be able to do some of these special methods. But
the poll is now closed, and here are the results.
Very good. Step 3, determining the transaction price. And now I'm going to pass it along to Adam to talk about 199A.
Thank you, Andrea. So my name is Adam Sweet. I'm based in the Spokane office, and my focus and my practice is partnerships and S corporations, flow-through entities. And so the big news for us with tax reform is 199A, qualified business income. And if you think about it, it's just the counterpart to the C corporation tax rate was cut. And so Congress gave us Section 199A for S corporations and partnerships and sole proprietorships to provide a tax cut, if you will, to those businesses. So really any business, any contracting business out there, as long as you're not a C corporation, you should be thinking about 199A and whether you qualify or not. It's not unlimited. We're going to do the 30-second recap here, 199A, but just remember it's not unlimited. Just because you have quote unquote qualified business income, it doesn't mean you automatically necessarily get the deduction. But also, if your taxable income, not your gross income from your business, but your taxable income that you report on your 1040, if you're below certain threshold amounts, then you don't even have to worry about those limitations. And so those threshold amounts are, if you're married, it's $315,000. And if you're a single filer, it is $157,500. So just, big picture, you would expect for most contracting businesses, we would surely expect that you'd have qualified business income. And just pay attention, though. Again, that's not the end of the equation there, that you need to pay attention to some of the limitations, including, are you paying wages as part of that? And then also, do you have depreciable property as part of that business? And there's just those numbers, the wages paid and then the unadjusted basis in your depreciable property, they go into kind of a limitations test. We don't need to get into that today, but just something to pay attention to. Now, the only thing, even though generally speaking, we would expect most contractors to be generating quote unquote qualified business income, the one thing to be careful of is if you have a small amount of service revenue, and it's a specific type of service revenue. The statute calls it a specified service trade or business. If you have a specified service trade or business, that income is not QBI and you don't get a deduction for it, generally speaking. And the problem is, though, that if you have an otherwise good business generating qualified business income, we have some proposed rules that came out in August that say, depending on your gross receipts, if your gross receipts are over 25 million, if more than 5% of your gross revenue comes from a specified service, a tainted service business, it taints the whole business. And then if you have gross receipts of under 25 million, then there's up to a 10% threshold. But it's the cliff effect in a way, because you can get right up to the cliff. I mean, say that you have a business of gross receipts under 25 million, you can creep, 8% of your gross receipts is okay if it's from a service, 9% is okay, 10% is okay, but the moment you take a step over 10% of gross revenue, you fall off the cliff and you end up at the bottom, meaning you get $0 of deduction. So there could be, if there's some consulting, I don't know whether you would see this typically in the contracting industry, but maybe if there's some consulting to a client is provided as part of a construction project. If there's maybe consulting would probably be the category you might see. And it doesn't mean necessarily we expect to see it, but it's just something to pay attention to. If it is a problem, there's things we can do. If you sit down and it turns out that that is a problem, there's things we can do to restructure to maybe carve off that bad income. Also, things to pay attention to, if you own multiple trades or businesses, this could be maybe you own interests in multiple entities, multiple partnerships or S corporations, and you're getting K1s. You can put all of those businesses together. You can aggregate them for purposes of 199A. And the reason why you would do that, one, it's just a more efficient process to rather than computing a deduction separately for each trade or business. If you can put them all into one pot, it makes it just easier and more efficient to compute the deduction. But two, if you have one business and you have an issue with that business because maybe there's not enough wages or you don't have enough basis in that business, so that business on its own, your deduction could be limited. If you can aggregate that business with another business that has enough wages, you can put all that stuff into the common pot and potentially then maximize your 199A. So to aggregate, you need common ownership, and then you need some relatedness between the different businesses. And we won't get into too much of the specifics on that, but if that's perhaps if you're interested in it, or if this looks like it's an issue, meaning that one of your businesses maybe is going to be wage limited, or maybe you don't have enough basis, then you should think about talking with your tax professional about, hey, can we aggregate this business with another business? Then one other important point, as of now, these proposed rules that came out in August, as of now, aggregation is done at the individual taxpayer level. So S corporations and partnerships, if you have a contracting business, say it's an S corporation that maybe you own a couple of different businesses underneath it, the S corporation does not aggregate those businesses together. The S corporation will have to separately report each of those trades or businesses on a K1 and provide the relevant information to the shareholders. And then the S corporation shareholders, to the extent that they're individuals, they'll be the ones that make the decision to aggregate or not aggregate. There's been some discussion, people have been pushing the IRS to allow aggregation at the entity level, at the S corporation level, just to make it easier. We'll see, we don't have final rules yet, but so maybe this will change, or maybe it'll be optional that you can do it at the individual or the entity level. But as of now, it's done at the individual level. Self-rentals, this is a very common structure. You're going to see it in the contracting space. It's just a very common business structure. Self-rental, the idea is you own your operating business, in this case, your contracting business on the right side, and then you also own real estate on the left side. And the real estate is used exclusively by the business, and you have common ownership between the two. The owner of the contracting business also owns the real estate entity. And it's a self-rental because the contracting business pays some rent over to the real estate entity, but because of the common ownership, there's a lot of flexibility there in terms of setting rent amounts. If it's more advantageous to pay less rent to increase the contracting business's income, you could do it. Or if you wanted to push more income over to the real estate entity, you could do it by increasing rent. So what the IRS did in the proposed rules is we're going to treat everything in that box. If you look at that red dotted box, we're going to treat that whole thing as one business, and it all generates QBI. So if it's the rental income and the contracting business are in one bucket. And so from the IRS's standpoint, they like this because they say, hey, you're free. If you want to push a bunch of rental income over to the real estate entity, you can do it. If you want to push a bunch of income over to the contracting business, that's fine too. We don't care because it's all one bucket of income at the end of the day. Quickly, we talked about you need wages as part of your business. So if you have QBI, you need to pay enough wages to maximize your QBI deduction. The question came up over the summer was, well, what happens if your business doesn't actually pay the wages? What if you have a contracting business and you actually pay a third party to do all the HR functions and to issue the W-2 wages? We see this fairly often for larger businesses, and we call them PEOs, or the name of these entities. They're called professional employer organizations, and kind of their sole job is to be basically the employer and issue the W-2s and do all of the HR component to that. So we get a very helpful rule if your business does that, either if you use a PEO or if you're using some type of commonly controlled entity and using it as a common paymaster. The IRS gave us a very helpful rule and said you can use those wages even though you're not necessarily paying those wages directly. Also, if any of your businesses are paying a guaranteed payment, I don't know if this is fairly common just amongst all businesses in the partnership setting. If you're paying a member a guaranteed payment is not eligible for 199A, but we've been pretty successful in many instances of looking at that and maybe converting the guaranteed payment to what I'll call a net income allocation and making that eligible for 199A. So this example just shows it there that you can generate, without changing the economics, you can generate basically a deduction, an increased 199A deduction. So if that's of interest, feel free to reach out to us afterwards or talk to your local Eide Bailly tax professional if this is an issue you face. Just to wrap up 199A, we're starting to get into the heart of busy season here. It's a whole new ballgame for reporting and compliance, that all these things that we have never had to track before for 199A, we now have to track. And we have to track qualified business income on a business by business basis. We have to figure out wages, we have to figure out the basis and property, and then you have to put this on the K1 and provide enough information out so that the owners, the recipients of these K1s, can compute their 199A deduction. So we have proposed forms, actually I think they're final at this point, some tax forms from the IRS that are giving us some guidance on how to do this, but again, it's a whole new ball game. We didn't face this last week, or last year I should say, so these are all new issues that we haven't faced before. Just quickly, it's changing topics from 199A. Opportunity zones have also been in the news. This was a provision that was put in as part of tax reform at the end of 2017. There's a lot of interest out there on it. So we thought today we'd spend a couple of minutes and maybe just cover the highlights for what an opportunity zone is, or what the provisions are, what the tax benefits are. The basic idea is if you have capital gain, eligible capital gain, you can choose to defer that, meaning you don't have to pay tax on it, if you invest that capital gain into a qualified opportunity fund, a QOF, within 180 days of selling the assets. So easy example is if you sell stock, publicly traded stock, and you recognize capital gain, within 180 days of selling that stock, if you want to, you can invest that capital gain into a fund, and then you could defer that gain. The fund generally is a partnership for tax purposes, but it can also be a corporation. And then the turnaround is the fund then must take that money and invest it into an opportunity zone. And these are opportunity zones are designated tracts, typically low-income tracts of land, that the state governments, state and local governments, working with the Treasury Department in DC, designated. And so the whole focus of the program is to get people to invest cash into a fund and then have the fund invest that cash into an opportunity zone. Just this chart here outlines some of the benefits you can get from that. I'm way oversimplifying these provisions just for purposes of time. I mean, we could spend an hour just explaining the intricacies of opportunity zones. So if you're interested, reach out to us afterwards or talk to your local tax professional on it, because if you have eligible capital gain and you're thinking of doing this, there's a lot of nuances you should pay attention to before you do it. But here's the basic tax framework or the tax benefits provided by Congress in this. So if you invest $100,000 of gain, we assume it's qualified, you put it into a fund, we assume the fund is doing everything correctly, checking all the boxes and doing everything that the IRS requires it to do. Here's what happens. So the first step is if this is in 2019, taxpayer can defer the gain, meaning they don't pay tax in 2019. If they hold it for 5 years and sell till 2024, they get a $10,000 step up. So they put the $100,000 into a fund. They have zero basis in that fund because they didn't pay tax, but you get a $10,000 step up in 2024. If you hold it for 7 years, you get an additional $5,000 step up. So a total of a $15,000 step up. In 2026, it's a typo, that should say 2026, not 2016. My apologies. But in 2026, you recognize $85,000 of the gain. So you put $100,000 of deferred gain in, you'd recognize $85,000 of it because you got a $15,000 step up. And then the real juice is if you hold it for 10 years, all of the post appreciation or the post investment appreciation in the interest, you could sell and exclude from tax. So if your interest is now worth $200,000, you put $100,000 in, now it's worth $200,000 and you sell it, meaning there's $100,000 of appreciation. All of that appreciation, you could, if you do everything correctly and the fund's done everything correctly, that gain would not be subject to tax. So that's the basis steps ups are nice at year 5 and 7, but the real attractiveness of this program is all of the post-investment appreciation being excluded from tax. So it takes us to our third polling question, true, false. So if you taxpayer invests $100,000 of qualified capital gain into a fund in 2019, and assuming all requirements are met, is there a potential tax benefit?
The third poll is now open. Okay, we're going to go ahead and close the poll. And here are the results.
Excellent. Sounds like everyone was paying attention. So indeed, that is the primary driver of these provisions are the tax benefits. We'll turn it over to Andrea.
All right, I think I'll take the first here. Andrea and I are kind of splitting up this one, but a quick talk through what's changed for full expensing of qualified property here with tax reform. Some change, some is kind of similar to in the past, but we'll run through first the bonus depreciation. So what's changed for bonus depreciation? And this is the big one that has changed from prior years, and that's that the TCJA increased the bonus depreciation to 100% for properties placed in service after 9/28 of 2017. So, there's a few months of 2017 that this rule changed stuff for, but then going forward up until 12/31/2022, there's 100% expensing for qualified property. And then after 2022, they kind of phased this back out, and that's kind of the whole thing in this act that, a lot of it, the corporate tax rate change was permanent, but a lot of the rest of this sunsets, and this bonus depreciation gradually sunsets through 2026. The other big thing on this, if you've followed how you're able to expense things in the past, is that bonus depreciation has historically been on new property only. And with this, they changed the definition of qualified property to include used property. So as long as it's new to you and you didn't previously have any kind of depreciable interest in the property, you can now expense 100% of it. So that, and the other part of this, it must be acquired and placed in service during the applicable window. So part of that also relates back to if you're constructing a building and you had signed the contract before that 9/28/17, there are some special rules on that as well, so that it has to be something that was bought and after this rule took place. The other part of bonus depreciation, this is strictly for personal type property under 20-year property. So you can't 100% expense a brand new building or something like that. The other part, they added this new section of property called qualified improvement property. And in this, they defined it as any improvement of an interior portion of a non-residential building if the improvement is made after the placed in service date. This is similar to some of the other prior years, but in the past, there's been some definition where it has to be put in an improvement made after 3 years. Well, now it's just as long as it's made after it was placed in service, it can be called qualified improvement property. And the benefit of this is that it would be applicable, or bonus depreciation would be applicable to it. The caveat on this is that Congress rushed through this bill and screwed up in how they wrote this part of the section. So if you put qualified improvement property in between that September of 2017 to the year end of 2017, it fits in this definition, and it's got a 15-year straight line recovery period, and you can take bonus depreciation on it. But due to a drafting error, if you placed it in service after that, it doesn't actually qualify for this new definition. This is something they've acknowledged, and in some of the bills that have not gone through yet but have been placed down on the floor, the fix is in there to redefine it. So if they make a technical correction on this, we will be able to do this. But this is great if you're doing, the remodels where you're not expanding your business, not expanding the building, but instead just doing improvements to the interior portion of it. You can expense 100% of it as long as they do this technical correction, which I think we're expecting, but who knows with how they're moving along right now. If they do not, it's considered a 39-year property. So that kind of a big difference in that one. This is a sketch, just a little sheet showing that phase out, how I talked until 2022, it's 100%. After that, it starts phasing down, and you'll see, it's 20% a year. So 2023 through 2026, you lose 20% every year. And then in 2027, there's no 100% bonus depreciation anymore. And I'll hand it off to Andrea here, where she's going to talk through Section 179 and how it's similar and differs a little bit from bonus depreciation.
All right, thanks, Dave. So as Dave mentioned, Section 179 is similar to bonus depreciation in that it allows an immediate deduction for the cost of qualifying property placed in service during the year. The amount of the limit on the allowable deduction is $1 million, and the deduction phases out to the extent that you spend more than $2.5 million on any qualifying property during the year. So in order to qualify for this, we do need to kind of keep an eye on how much property you're actually placing in service during the year. And they've also indexed amounts such as the sport utility vehicle limitation for inflation, so that deduction is now up to $25,000. They've also expanded the categories of qualifying real property that are eligible for Section 179. Section 179 generally applies to any of your tangible personal property. So your furniture, office equipment, things like that are eligible for Section 179. But in addition to that, certain improvements to buildings can be eligible for 179. Those include the qualified improvement property that Dave just talked about. And note that this property is eligible for 179 even if they don't get the technical correction passed. This doesn't matter what the recovery period is. As long as it meets the definition of qualified improvement property, we can deduct it in full in 2018 if you placed any in service. And then there are also some items here that typically do not constitute qualified improvement property, meaning that these items are generally not eligible for bonus. The reason being that a lot of these are exterior to the building. Qualified improvement property must be interior and non-structural, so things like roofs, components of the HVAC system, fire protection, alarm systems, security systems, things like that are generally not bonus eligible, but they are eligible for Section 179 under the expanded definition of qualifying real property. There is, however, they also repealed the exclusion for property used in connection with lodging. However, the non-corporate lessor rules are still in place. So lessors not organized as corporations can be limited in their ability to claim Section 179. And so we get questions from a lot of clients, what's the difference and why should I care? As long as bonus depreciation is 100%, Section 179 is 100%, does it really matter which provision I use? And in a lot of cases, the answer is no. There is a significant overlap in the qualifying property, but there are some items that are going to qualify for one and not the other. And those are the things that we need to keep our eyes out for. So for example, the property that's eligible for 179 but not bonus, that's going to be the roofs, HVAC, security systems, et cetera, on the prior slide that are not likely to qualify as qualified improvement property. There's also the dollar limit. So if you are placing in service a lot of property during the year, you may not be eligible for 179, but bonus is not limited by the amount that you place in service. You can take effectively an unlimited bonus depreciation deduction. Taxpayers not eligible for 179. So non-corporate lessors, certain estates and trusts are not eligible for Section 179. So you need to watch out for that. And then there are limits on the ability to take the bonus depreciation limitations, like for example, where Dave was talking about the qualified improvement property. Until that gets fixed, we are not able to take bonus depreciation on those items. Additionally, under the interest expense, there's some overlap between the bonus depreciation rules and the interest expense limit rules. We'll talk about in a minute that restrict those taxpayers from taking bonus depreciation. So those people need to be focused on claiming Section 179. And I think Dave is going to briefly walk through some of the changes with the like-kind exchange provisions.
All right, thank you, Andrea. Yeah, so one big thing they changed here for how we account for expensing and fixed asset additions is an adjustment to how what's qualified for Section 1031 or like-kind exchanges, as you might refer to them. And they've scaled back what's allowed. So now, in the past, you used to be able to, any kind of business property, basically, or investment property, you were able to exchange in a tax deferred method. And what they did is remove the definition from the definition personal property. So now it's only real property that you can do like-kind exchanges on. What that affects in your business is anytime you're trading in a truck or trading in equipment. In the past, we've just deferred, not recognized any gain there, and then your basis is reduced in the new property. So if you traded it and got $100,000 trade value on an excavator, you didn't get that additional $100,000 in depreciation, only what you paid in cash. Where now, if you get $100,000 of trade value on a piece of equipment, it's as if you sold it for that. You have to recognize a gain. The flip side of that, it seems like an awful thing. You're trading and not getting cash, and you're having to recognize gain. But with the bonus depreciation in Section 179, in essence, you're still going to get back to where you were in the past. It's not going to change a whole lot. There might be some instances where it does change the outcome a little bit, but I think they're going to be pretty rare. It'll just look a little different on your tax returns going forward. The one complication to this is that not all states are following this. We have a pretty wide practice area, so I'm not aware of how all states are treating this, but I know Minnesota has not adopted this. So for Minnesota, there are still 1031 exchanges on personal property, whereas for federal, there aren't. So we're going to have to kind of track them differently and basically have a different depreciation schedule between the two. I believe California also is not following on this, and I'm sure there's going to be a few other states as well. So that is one thing that is going to add complexity to the filing, and the states are going to differ a little bit from federal on how they're going to treat this. But for the most part, I don't think it's going to materially affect many of our clients, just because of we can expense anything that we're to offset the gain that we're picking up. With that, I'll hand it back to Andrea here, and she can run through interest expense limitations.
All right, thanks. So, as Dave mentioned, the interest expense limitations, and we referenced these earlier, under 163J, taxpayers are now limited to deducting interest expense up to the level of the sum of their business interest income, 30% of their adjusted taxable income, and floor plan financing. The good news is that adjusted taxable income for this purpose allows us to add back certain items that we've deducted for tax purposes, specifically business interest income and expense, net operating losses, and for the next few years, depreciation, amortization, and depletion. meaning that all that bonus depreciation that we're taking to drive down our taxable income, we get to add that back in before we compute the amount of this limitation. And that's going to be very beneficial for taxpayers, and we're hoping that a lot of our taxpayers will be able to avoid this limitation, that their total interest expense will be less than 30% of their taxable income once we've added back the depreciation. The issue here, though, is that if the depreciation expense that you're claiming is included in your cost of goods sold, so we see this a lot in manufacturers and occasionally in the construction industry, that the depreciation on your equipment and things used in those processes needs to be capitalized into inventory and therefore runs through your cost of goods sold. If that is the case, we do not get to add back your bonus depreciation or any other depreciation that you've claimed, meaning that taxpayers with their depreciation reported in COGS are more likely to end up subject to this limitation. And there's 4 very important exceptions to this limitation. The first one is small taxpayers, and these are taxpayers that meet the $25 million gross receipts test that Dave referenced earlier. So if your average annual gross receipts don't exceed $25 million, taking into account the activities of related entities, you are exempt from this requirement, so you don't need to worry about this, and you can deduct your interest in full. Additionally, real property trades or businesses and farming businesses have an option to choose not to be subject to the interest expense limits. The trade-off there, though, is they have to use a longer depreciation recovery period for certain categories of property. And then regulated utilities are also exempt from these rules, but I doubt we have too many folks that are in that situation. That brings us to our 4th question here. Utilities can be considered exempt from 163J. True or false?
The last polling question is now open. Okay, we're going to go ahead and close the poll and hear the results.
That is true. Certain utilities can be considered exempt, but not all. So I guess that is both true and false. And then I think we're going to hand back to Adam to wrap up with the discussion on the overall business loss limitations.
Excellent. Thank you, Andrea. So just 2 minutes to wrap up, which is perfect because this topic doesn't warrant anything more than that. But one of the other bigger provisions of tax reform last year was a limit on overall business losses that a taxpayer can claim. So traditionally, you could claim, if you had a loss from a business, you could use it to wipe out potentially all of your taxable income. And if it was more than your taxable income, then you'd have a net operating loss that you could carry forward. So we have a new provision of the code, new code section 461, that says, whereas before you could claim all your business loss, now you can only claim up to $500,000 of a business loss if you're married, $250,000 if you're single. This happens at the partner shareholder level. So if you have a partnership or an S corporation getting a loss, it happens at the individual level. If you're subject to this, then you don't lose the losses permanently. You just carry them forward as part of a net operating loss in the succeeding year. And this is an example you can look to on your own time. But the question that's come up recently is, what is business income? And specifically whether W-2 wages are business income. So if you have, let's just say you have a $500,000 of wages from whatever source, and you have $500,000 of business loss, the question, or let's say you have $1 million of wages and $500,000 of business loss, the question is, can you put those two together and net it out, or do you have to segregate those two things and the wages cannot be treated as business income? We've had some inconsistent guidance from the IRS. So last year they put out a proposed form for this provision, and the proposed form indicated that indeed W-2 wages are business income, so a favorable result. But more recently, we had some guidance from the Joint Committee on Taxation, quote unquote, the Blue Book, that said that maybe Congress intended that wages are not business income, so a less friendly result. You know, at this point, where does it stand? It looks like for the Joint Committee on Taxation's interpretation to become law, that will need a technical corrections perhaps. So maybe at this point, wages do count as business income, but it's something to think about still. So if you fall into the situation where you have wages and you have an overall business loss, you should be sitting down to think about, are we going to be able to net these two things together? And where do we stand in terms of taking a position? And that is it. I think we stopped perfectly at 11:30, so we can stick around if there's any questions, or I don't know if questions have come in, but
We do have one question that came in.
yeah.
I believe this goes to the beginning of the presentation. How does CCM apply to spec homes where there is no contract with a customer and projects frequently span more than one tax year?
Sure. You know, if you're doing spec homes, on those, you're subject more to the UNICAP type rules, where and inventory rules, where, you know, technically the home that you're constructing is an inventory or a like inventory type product. So you're having to capitalize all costs, and upon sale, that would be when you would recognize the income and the deductions that go along with the spec home. So I think hopefully that will address what you're looking at there. But yes, they're, you know, are different. When we're talking completed contract method in general, we're looking at if you have a signed contract, you're doing work, even if you're recording payments ahead of time. If you're on the completed contract method, you wait until you've finished the contract, and at that point you recognize the income. But similar, I guess.
Awesome, thank you. That is the only question that has come through. All right, if you guys have any more questions, feel free to reach out to our presenters today and they can help answer your questions. We will post this recording and send it out to all of our participants. And just keep in mind, if you are watching a recorded webinar, it is not worth CPE credit. So thank you to our presenters and thank you to our attendees, and everybody have a great day.
Thank you.
Thank you.